most traders lose by overcomplicating the markets. Today, I'm sharing what transformed my trading, a method ignored by most for being too basic. It's not a secret, it's a filter that significantly reduces my losses and works with any strategy. Watch the video till the end as I'll share a full strategy and different entry types that you can use immediately. Let's get into it. Now let's start with what everyone is doing and what I used to do. So what others do is, this is a key level. So any key level that you use, either an imbalance, and we're gonna go over this later. So that is a key level. When price goes above this key level and break above it, what most of people are gonna do, they're gonna still maybe extend this key level all the way up here and look for this market section shift. Now this one is not valid. Why? Because we already violated this key level, so we already disrespected this key level, going up, and then just a minor pullback, and then a market section shift. This is seen as a market section shift, when in reality, I see it as a pullback to the downside in order to retest the key level in order to go higher. So you see how some people looking at this level as a market section shift, when others looking at this as an entry. So what I used to do is look for market section shift here, and now what I do is look for an entry here, because all of this does not matter. The market section shift or the breaker structure needs to be happening here inside of this, and I need to see price respecting this key level. I don't want it to see going above the key level, because that is already disrespecting. Now there are some scenarios and some cases where price could go above the key level, so could go above the key level and then go lower and retest the key level. So in this case, it can do this, go above and then break lower and then come back here. But in a lot of the cases, what's going to happen is price disrespecting this and then retesting. So basically ignoring this, what's happening here, and looking at the higher time frame, for example, what we can see is key level disrespecting and then a retest and going higher, because we already violated and disrespected the key level, when in reality, to go short in this case, we want to see price staying around this level, respecting, at least staying inside. Now we're gonna go over what do we need to see exactly, but in general, what I want to see is at least price staying inside of this range and then going lower. At least, even if it's ranging inside, I would take it. There are some better scenarios, but even this better than going above and then retesting. And if you notice, a lot of time what's going to happen is price going up here and then going lower, and you're going to see that price give a reaction at your entry. So let's say here at your entry, when we got the market section shift, but only price coming here and you'll be so happy that it's going to your way. However, it's only going to the key level to continue higher, because that is the main direction. So what I want you to do as of now is go to the chart and look at some of the trades that you have taken. Maybe you were looking for this market section shift, when in reality, the trend is just going higher, and especially that the key level was disrespected with a displacement. There is a gap here that needs to be filled, so that is just a minor pullback to continue higher. Now, I'm not going to waste anyone's time. We're going to get straight into the candle rule, and that is the main premise of the video. It's, respecting and disrespecting candles. Now, I know that some people already explained this, and I want to also make sure that that I also explained this before, and I've been using this for a while. So it's common sense. It's something that is very basic, yet a lot of people just trying to solve the market instead, and look at the secrets of the market, when the reality is keeping it simple is better for you. So you got to keep it simple. You got to look at the basics and follow them. That's better than solving the market, actually trying to solve the market and then failing. That's going to lead to nothing. So we have two scenarios here, and that is going to be the main rule of the video. The first one is, this is a key level and we're looking for short opportunities from this level. If, for example, that is a key level on the 4-hour time frame, in order to get a very nice, and actually a very nice entry, you can look at the 15-minute or the 1 hour. However, if you want to be on the right side, regardless of the reward to risk. If you're not aiming for high reward to risk, then you could look for the 4-hour. On the 4-hour is going to be more accurate than a 4-hour key level and then 15. However, the 15-minute is a must to get a high reward to risk. So the rule says if we respect a key level, and this key level needs to be a refined one. So I'm not going to be using a fair value gap that is very big like this, or a support level that is this big, and then the candle comes here and respect it, and I'll say, oh, that is actually respecting the level. No, it needs to be a refined one. Now, the first scenario is respecting by a wick. So rejecting the key level by a wick. This one, a wick rejection, it means that the key level is respected, and that tells you that there is a weakness here. So in this case, since we are, pushing lower, there is weakness here. We can see that price is not able to go above the key level. That is the first sign that we might see a respect to this level, and we might see a reversal. So the rejecting by a wick means potential reversal. Now, on the other hand, this candle here is very strong, that it did not pay any attention to the key level, and it did not even range around it. So what happened is, in one candle, we did disrespect that key level with one candle, and that candle is very strong, a lot of displacement in this candle, and we closed above it. Now, there are some scenarios where we can just go lower and then push lower, all right, and continue lower. However, we think of probabilities. Everything in trading is about probabilities. The probability, or at least the indication of this candle, this strong one here, it's telling me that most likely we can see continuation. So we open here, go lower, and then continue higher. Why? Because we already violated the key level. On the other hand, on this one, we can see a respect. That is the indication that we could see a reversal to the lower side. So we open here, go higher, create a wick, and then go lower. So for this one, wick rejection means reversal. On the other hand, this one is a body closure. That means key level violated, and that indicates what? A strength on the market. So that is, a sign of strength. And what we can expect from this is a continuation. So body closure means continuation. Wick rejection means a reversal, or at least a potential reversal and a potential continuation. That is the main thing on this video. Now, do not stop watching here, or if you think that is enough for you, yeah. But what I'll do is go over more details on this, how to enter, how to find the best entry, some rules about the key level, and all of these things are going to be in the next slide. Now, that is the current chart of the dollar yen. What we can see is that almost every time, I'm not going to say every time because there's nothing, it's all about probabilities. Again, I'm not saying that this thing works all the time, and there's nothing that works all the time. So what we can see here is that failing to displace above this high, what happened? Pushing lower. Failing to displace above this high, pushing lower. Sometime it's going to be a pullback, and sometime it's going to be a change in the direction. So we cannot know which one unless we combine other things with this concept. And that's why you can actually blend this to your current setup. So you don't need to switch to a new strategy. No, you just blend this and try to improve your strategy by blending this. So you see, going lower. What happened here is, I'm not sure if it takes that one, but this one, failing to displace below, means we're going higher. Either that is temporary, or it's going to take a lot of time. We're not sure unless we combine other things. So you see, failing to displace, going higher. Here, failing to displace. However, the candle after, we just go higher. And that is totally normal. As we say, there's nothing that works all the time. But you see, failing to displace mean pushing higher. This move here, if you trade on the 50-minute time frame, you can actually get a lot of reward to risk from this. And this one is the change in the direction. So you see, this last sweep here, failing to displace below, actually failing to close below. This is what happened after. Now you can see, same thing here. Here we close above, that means we can see continuation. Closing above, expecting continuation. Here, reversal. Here, reversal, and then you see this one, continuation, continuation, and here it's actually a reversal. And we're gonna just, go over this in details on the next slides. So what's gonna happen if we have this high not closed above, but then the one after is closed above? However, it does not close above the previous candle high. That is a sign of weakness. Now we're gonna know which one is a weakness, which one is strength, what are the special cases. But that is the main premise of the video. Sticking to the basics, displacing or actually closure above a key level or closure above highs, that means continuation. Failing to close means reversal. Now the key level types, you could use imbalance, you could use liquidity, you could use a wick, and that's something that I'm gonna be introducing in my next videos. You could use SNR levels, but all of these levels needs to have something in common. In order to use the candle confirmation entry, what we need to do is refine the area or refine the key level. It should be relatively small compared to the surrounding. That means if I have price going up like this and then pushing lower, to see this small move here, if the imbalance, for example, is this big, it's not going to be valid because price could give a wick here and then continue lower. That's why we need to refine. So when it comes to imbalances, for example, liquidity is already refined because it's just a high, right? So if I see failing to displace above, I could take it, but you could also look for a key level above the liquidity. Imbalances, you could focus on the 50% of the imbalance. That's going to be better for you because now you're refining for this specific entry type. However, if you look for the typical flip or the typical market such a shift, you could use the whole imbalance. Wick, you could use this entry with the wicks, and that's something that I'm gonna be again introducing in the future. And also with SNR level. So let's say we have a strong level here. I'm not gonna be taking this SNR level as a whole one. I'm gonna be refine it and make sure that I'm focusing on a specific area where if I see the first sign of rejection, I'm gonna enter. However, if you take, or if you look for another confirmation type of entry, then you could look for the whole area. It depends on how risky the entry is. Now this method can tell us when the reversal is happening, as well as an indication of the direction. Now what does that mean? Bearish candle, and these are bullish candles, right? So that is a key level, and we're focusing on 50% of the key level. Now this is an optional thing. Now you see how we are pushing lower and then pushing lower, and what happened here is respecting of the key level and respecting the 50% of the key level. In this, at this time exactly, the indication or the sign that I'm getting from the market at this specific time is a potential bullish momentum, at least a temporary direction to the upside. Why is that? What happened here is a respect of the key level, even though this is still a bearish candle, but it got rejected from the key level, I can expect the next one potentially to be a bullish one. And you're going to see that this happened a lot of times, and I'm going to go over the examples later. But that is, that rejection is the first sign of bullish direction. That is the first sign. Now it gets more confirmed when we close bullish after, especially if it's a strong candle. And then what you can trade, now we have different entries here, but you see how based on the CCT or the candle continuity theory, and I already explained this, just look up on YouTube, candle continuity theory, Mulham trading, and you're going to see that one. What happened here is because we close bullish here, we can anticipate next candle to be bullish. What happened is opening here, going lower, and then breaking out above. You can look for an entry at the wick of the next candle, the second candle on the bullish side. All right, so the second bullish candle, we can enter here. And again, this is just an overview. We're going to go over every type of entry later. But you see, that is the first sign of rejection, of reversal. And from this candle, when it closes like this, you can anticipate the next candle to be bullish. Now this can be applicable on a weekly. So if a weekly candle closes like this on a key level, you can expect the next candle to be a bullish one. So you cannot look for CCT here. That means I'm not anticipating the next candle to open higher and then go lower. No, I'm anticipating this candle to be a bullish one, and then I'm going to be trading this one. Now you can also find an entry here, and I'll explain this later. So just a quick example on this. I know that it kind of looks complicated here because it's all over the other, but it's very simple. You can see that we have this imbalance here. What happened is price respecting 50% of the imbalance. You can just immediately look for entry here. If you like, swing trading, even on the 4-hour, you can just enter here with a stop not below the, now sometimes you're going to get stopped out because this is a very risky entry. You can put it below. You can use ATR here, and you see next candle closed higher. Now at this point, you can look for CCT again here, continuation, and that is a very nice one. So you're going to enter at the breakout of the candle with a stop loss below the wick of the 4-hour. That is a continuation. You see, we have this wick here, this key level. I'm going to call it key level from now on. Respected here. What happened? Even though this is a bearish candle, we can anticipate the next one to be a bullish, and that's what happened. And then CCT here, because now we close bullish. That is the, I would say, the second step or the second phase of the market reversal. And then we have the continuation here. Going higher, key level, same thing. You see how this one closed above, even though it's bearish. However, next candle just goes up, and you can look for CCT here again. And that is the cycle of the market, and that is what we're going to be using today. And that is just the first thing that you can apply to your strategy to make it better. And it's really easy to understand. Now, in the previous slides, what we discussed is key level and then closure above, rejecting from that key level and closing above. Now, it's not all about key levels. We could look at candles themselves and apply this rule. So how is that going to be? You see how this candle go higher and then closed here. But then the candle after it opens, so based on CCT, we can expect a continuation. However, what happened is price opening here, creating a wick, going up and failing to close above the previous candle high. That is another indication that we could have a reversal, or at least it's a sign of weakness. And then you see the next candle also staying in the range of the previous wick, or the upper wick of the previous or the first bullish candle. So you see how we're staying in this range? Weakness, weakness, sweep, sweep. And then after that, we can expect a move to the downside. And that is what happened here, move to the downside. So failing to close above previous candle high multiple times, indicating weakness. So you can just, get a sense of weakness from here, and we can look for this entry. So you could, based on, for example, a POI or a key level above another one or refined one, you can see this, and then after the flip, you could look for a low time frame confirmation. However, you can also look for the CCT here. So enter at the wick and then look for the breakout, or look for the breakout and stop loss here, and then follow the trend. It could be a temporary move, or it could be, a move to days or weeks. That is an example of weakness and strength in candles. So you can see how we have this high, and then we take some time to break above. But you see what happened? This is your first sign. So that is a key level, and we failed to close above. So that is your first sign that we might see a reversal. But then what happened after? Sweep, failing to close above the specific high, failing to close again, and then this candle just comes, sweeps, and close bearish. You could trade the CCT here, also here, or you could find an entry here if there is a key level, a refined one to the left side. Now, same thing here. You see how there is no key level here, but you see how this low here was not closed below with a body, and also same thing here, not closed below. And this low here was holding very strong to these two candles, and then this one goes above and break out of this weakness range, or actually strength in this case, because it's holding to the upside. It wants to go up, so it means that it's so strong, and then going up, and then CCT continuation here. And this is how we get the signs of strength and weakness just based on candles themselves without the need of key levels. However, if it's with the key levels, if there is a confluence of a key level, that means it's even better. Now, the last thing that I want to discuss is the entry types. I'm not going to give examples on this because I give different ones previously. And if you want a whole video about this specific concept, the entry types, and show you how you can have multiple positions, how to scale in just based on this, I can do one. Now, looking at the same thing, a key level, and then price is going lower, creating a high, then breaking below. However, even though we closed below this level, we closed out of the key level here. So we rejected of the key level. What can we anticipate from this? We can anticipate a change in the direction just based on this itself. Now, as I said again, sometimes we're going to be closing below a low, however, not below a key level. That still means we have a reversal, because that is what? If we look at this is, for example, the 4 hour, the daily is going to be only a sweep, no bodies. Now, the first position that you can enter from these 4 types is the aggressive entry, and that is going to be the low risk one. Now, low risk does not mean that it has no risk, as you know how risky the position is. No, it means that low risk is how much you're risking of your money to enter this trade. So we're going to be looking at low risk. So if you're basically most of the time, you know, trading with 0.5% or 1%, let's say 1%, then this one, you're going to take it with low risk, maybe 0.5%. So always go half risk on this, or maybe more than half. And then the one after is going to be, these are, I would say, this one is the more risky one. This one is a little bit less risky. This one is the safest. And this one is safe and risky at the same time. And we're going to, you know, discuss why is that. The second one is going to be this one, the CCT entry. So based on the candle continuity theory, the moment we closed above here. Now this one, again, we're going to be entering at the closure of this candle, and then stop loss. See this low? A bit below. So maybe here, below the key level, in case price sweeps the low and then reverse immediately. The second one is going to be the CCT entry. Based on this closing bullish, we can expect a creation of a wick and then breaking out. We can enter at the breakout, for example here, with a stop below the wick. The conservative entry is going to be when we have breaker structure above this key level, and then we close above. So you see, we have a key level, we closed above it here. What did we discuss in the previous slides? That when we close above a key level, what we look for is a continuation from it. That is a key level. We closed above it here. So even though it's bearish, however, we rejected with a wick from that key level. What we can do is enter here immediately. And then you see the next candle just went up. Same thing for CCT. So this is a CCT re-entry. And what I say is that this one is safe and not safe, risky and not risky. Why? Only if you're just at the beginning of the trend and you have very clear key level, you know, way above this area, then you can enter. However, if you're already reaching, or you know, this candle here already kind of reaching a key level, then it's very risky entering from this CCT. Why? Because your price position is not good. You're almost entering at the top of the range. So you have price going up like this, you go up, you entered long here, and you want to enter. So for example, you have a key level here, you want to enter long here again to this key level. It's not worth it for me. So it depends if it's worth it or not. You can say if it's risky or not. These are the entry types that if you focus on, then you can make it in trading. You don't need to use these exact ones. I want you to take the idea and then play with it, get some inspiration and blend it and try to improve your trading strategy. That is the main thing. I'm not asking you to enter here. Maybe based on your, trading strategy, you enter here. So it depends on your trading style as of now, and then you blend this with it. So that's it for the video. Hopefully you learned something new. If you like the video, then make sure to hit the like button, leave a comment, and subscribe to the channel. Maybe share the video with other friends to help them in their trading journey. That's it for today. This is Mulham, and I'll see you in the next video.